Commodity prices are falling around the world, and that's a phenomenon made in China. And behind that is the fall in investment in China. With me to discuss it today is James Kynge, our emerging markets editor. James, we've had some charts made up that show some pretty dramatic things going on behind the story of investment in China. A lot of people talk about the red line here on a chart showing fixed asset investment, and that is running at more than 11% in June. Yeah? Why, in that case, is China not powering ahead with demand for commodities?
That's a very good question. People around the world looking at that red line on the chart showing Chinese fixed asset investment so robust would be wondering why commodity prices are tumbling everywhere. Yeah. And the reason for that is contained in the blue line. The blue line shows a much cleaner representation of what companies in China are actually investing to boost their productive capacity. The reason why people look at the red line is because the blue line is only announced once a year. So that's an annual number. Right. But estimates from Gavekal Dragonomics in Beijing show that the blue line so far this year is running at around 4 or 5% growth. That's a lot lower, obviously, than the red line, and it's a lot lower than the 25% increase in gross fixed capital formation that China saw back in 2009. Right. On a net basis, it's also the case that means if you strip out depreciation from gross fixed capital formation, it's very possible right now that China is experiencing negative capital investment. Right. And that, I think, helps to explain why commodity prices all over the world are tumbling.
Right, so it's not just that growth in investment is slowing, it's actually turning negative.
Exactly.
And so for some commodities producers, demand, their biggest source of demand, has simply ground to a halt.
That's it.
Let's have a look at our next chart then. It's another piece of the puzzle of what's behind it. Just to explain briefly, these are local government financing vehicles. This is basically the demand of local governments, which are a big driver in China. And what you're showing us here is that the return on their investments is very low when they actually build stuff, but their financing costs and what they can make in the financial markets are a lot higher. So the real world doesn't match up.
There are about 10,000 or more local government financing vehicles across China. They are a huge, huge driver of infrastructure investment. They're the ones that build the roads, the highways, the bridges, the ports, etc. Right. And what we're seeing here is that it simply isn't economic for these LGFVs to invest in infrastructure these days because they're getting an average return on their assets of around 3%, as shown on the chart, whereas they're paying out in interest on their loans about 7, 6.5, around that area. So they're losing in terms of the investments they make on infrastructure. And that's one of the key reasons why infrastructure investment in China these days is so weak.
Right, because the local governments themselves have to make returns on those investments, and that's just not happening. Okay, let's move on to the next chart. Now this, I think, is particularly impressive. I mean, talk us through it, but we can see pretty clearly at the right-hand side of that chart, all the lines going down below zero. The amount of financing in China is actually turning negative, is that right?
So what we can see from this is that the demand for financing in China is turning negative on a year-on-year basis. So as we've mentioned, the demand for infrastructure investment financing is very weak. Property, we're seeing at the moment inventory levels, that means unsold inventory in property all over China, at around 11 months of sales. So right. Very high, meaning that property developers have little incentive to invest. And as I mentioned at the beginning, the gross fixed capital investment, in other words, investment by companies in capital goods to boost their production, is also turning negative on a net basis. So all of these factors together mean that the demand for credit and the demand for financing of all different types is slackening very sharply. And that's what's shown in this chart here. This is total financing. So that's the bond market, the banks, shadow finance, etc., etc. All of the finance together, we can see that on a year-on-year basis, we're in negative territory. This is what is meant by the Chinese credit squeeze, or some people even call it the credit crunch.
Right, and what's the feedback from that to the rest of the world?
So the feedback from that to the rest of the world is that people shouldn't expect that China will immediately turn the corner and start re-energizing global markets for commodities. This shows that the reasons behind China's ebbing demand for commodities remain quite strong and quite structural.
So for now, it could well be that low prices are here to stay.
As far as China's demand is concerned, that would appear to be the case.
James, thanks very much.